First off, your reaction to what Fitch has done and the response from the Ministry of Finance.
Surprise, surprise. You know, China has been on a negative side for several months now. I remember also when the last downgrade came, also that included Hong Kong. That upset China. The issue with this is on one hand, rating companies have to look at sizes of debt. The second part is in the case of China, all the debt is domestic. In other words, China owns money to itself. It's not going to affect either the interest rate or the external capacity of China to fund whatever it is doing outside. So in a way, it's a little bit silly. What, China is going to default on its own domestic debt? This is not going to happen. So on one hand, having a large amount of debt, which was based primarily on mortgages and primarily on land, that is, I'm talking about the municipal debt, it's not a very good idea. On the other hand, putting it down to negative, I'm not quite sure means what.
What do you make of China's response? How much sway does it have when it says that it has strengthened the management of its local debt?
The answer is yes, because we have been observing what has been happening in terms of, let's say, verbal encouragement on the local markets. And at the same time, certain strange things has been happening. China just issued about a month ago, if I remember well, 1.2 trillion of domestic debt to come out as part of its fiscal incentive. Well, now, this is central government spending the money, which apparently is okay. So one is looking at the fiscal position of China, which is modestly expansionary. The fiscal debt used to be something like 3.2, 3.3% of GDP, and it's likely to go up to 3.4, I even heard 3.7, which is peanuts if you think that Japan at one stage was 12% plus of GDP. So China is modestly expanding its fiscal deficit and its fiscal initiative, and at the same time says, well, we're not particularly, let's say, worried about the debt of the local administration, which is altogether different, because ultimately it is the center which is standing behind the, let's say, the worthiness of the locals. In other words, bottom line is the central government may very well need to take the tab, although they are not saying this.
So it has made an improvement. The question is really whether it can resolve those risks. China thinks it can. Do you think it can?
Again, I'll take a deep breath, and I can tell you, any country which is a huge net lender to the world, China is a huge net lender, not a borrower to the world, okay, has no external impositions on what's happening. I could take the other extreme of Argentina that owes money both domestically and externally, so their hands are completely tied. In the case of China, the only thing they need to concern is their domestic situation. And that is much more easily doable because 1/3 of the banking system belongs to the government. So it is unlikely that they are going to be put under market pressure if they are not resolving very quickly their domestic issue of debt. And they are saying they are doing it, and I do believe, of course they are very concerned, everybody else is concerned. They never said, the domestic debt, it really doesn't matter. Okay, particularly as if it is still connected with property. Remember, you can't remove the two things. All right, so they are right, and perhaps the external creditors, okay, are clear in their throats, but again, we're missing the point. This is domestic, not external.
Andrew, all things considered, is it time to perhaps increase your exposure in China?
Only selectively. Good God, I sound like an economist. I hate this. In other words, I will tell you that macroeconomically, I will tell you there are still a couple of things that I would like to see. But then when we turn back to the domestic side, it is clear that the emphasis on what is going to drive the economy forward, okay, has now been slightly shifted to just infrastructural investment. And of course, what's happening to consumers is very important, and hence the obsessive attention, rightly, that the Chinese authorities are spending on what's happening to the stock market, because that's the first thing that it is reflected in the headlines and perhaps possibly hit the pockets of a few million of the domestic investors. So the answer is I will be looking very carefully at some of the domestic companies, as opposed to of giving a blank, let's say, macroeconomically plus. And let's not forget that the great little sideline of that is, of course, Hong Kong. And poor Hong Kong, one cannot give them, hey, go ahead, full on, without American interest rates falling. And American interest rates are not falling. So I can't possibly tell you that when I look at Hong Kong and I look at the interest rates in Hong Kong, I have a big smile in my face because I don't believe the Fed is not going to cut interest rates anytime soon. Hence, Hong Kong is not going to receive any good news. And a great deal of China is being traded also in Hong Kong.
Let us talk about the Fed. I mean, that CPI print front and center. Andrew, I mean, you know, the question is really whether it's 2 or 3 and how strong the U.S. economy really is. The thing is, if the U.S. economy is resilient, it's very strong and data is supporting that, why does the Fed actually have to cut?
Look, there are 2 reasons for that. One is that they said we are having to control inflation, and once inflation is near our target, there is no reason for us to have historically high interest rates. Point number 1. Point number 2 is, of course, one is asking whether the level and size of interest rates in the United States is at a level that somehow justifies leaving them there because of the importance of the better performance of the economy. Sounds a little bit verbose, this, but the Fed has cut itself a rather awkward piece of policy making. Okay. Also, and that's hugely important, actually I'm afraid I have to set a question to myself and then proceed to answer it. The target is 2%. Rate of inflation right now is 3.1, 3.2%. It is 33% higher than their target. Well, then I can't possibly look at them and say, well, you're meeting your target, so let's cut interest rates. No, they are not. Every single CPI number in the last 18 months has got the number 3 in front of it. Then for something blah blah after that, and that blah blah has been going up and down. It is not something that it started with 3.9, 3.8, 3.7. No, it is not. It went up to 3.1, then it went up to 3.4, and if somebody would say it is not really on a determined move downwards. So if the Fed is to be believed, we want 2%. Look at my fingers, 2%. Inflation, and inflation is 3%, we haven't finished. You know, I'm a simple guy. I simply do what I'm told. You know, I'm not going to say, well, the Fed really doesn't believe on the 2% inflation. They really are believing on a 3%. Well, they haven't told us so. That's why, you know, I've stopped looking at the Fed.
All eyes, despite the fact that you're still looking at the Fed, all eyes still on the Fed. Yet, when it comes to conviction calls, you think the best way to play it all in the market is defense stocks. What's going on? Has it got to do with geopolitics?
It has to do with 2 things. First, defense companies, okay, sell to one client that doesn't care about interest rates. Hello, the defense client, you know what's that? It's the American government. The American government is not going to say we're not going to buy guns because interest rates are high. The defense sector is uniquely isolated, and I'm talking about not just United States, I'm talking about the defense sector in European Union and also in Asia. And also, I'm sorry, this sounds unbelievably immoral and a little bit hard. There are lots of juicy wars going on as far as the defense sector is concerned, and they are not seem to be going away. I'm sorry, it's a very crude thing to say, but there is an enormous wave of defense spending both in the European Union and also in Asia. And we keep forgetting Asia as if the only thing that matters is the Ukraine war. It isn't. Japan, South Korea and Australia are spending as there is no tomorrow, and they are not being threatened by Russia. Okay?